Okay, good morning, everyone. My name is Grzegorz Galusek, and I work for Microfinance Center for MFC. And I would like to welcome all of you today to this SIFTA webinar titled New Product Development Micro Equity. Today's webinar will last about 2 hours, and it is recorded. Please agree to being recorded. It's part of the requirement of the sponsor of this series of webinars, and that is the European Commission. Please feel free to ask questions. Of course, we encourage all of you to ask as many questions as possible, and you can do that either via the chat function, or you can make yourself visible. We encourage you to be to make this webinar as interactive as possible. Let me say a few words about our experts for today. So we have a great honor to have with us Artur Muntenau. Artur brings over 24 years of leadership in finance and MSME development. Most importantly, Artur is the former CEO and board member of Microinvest in Moldova. This institution currently manages over 200 million euros in assets and has a team of over 200 people. Artur also serves as an advisor and board member in diverse sectors and many institutions. He holds an MBA from the University of Hull, UK. So welcome, Artur, and I will pass over the mic to Artur in a few minutes.
Good morning, everybody. Welcome to the training.
Super, thanks. Thank you. But before I actually pass over the mic to Artur, I would like to say a few words about SIFTA, the program that sponsors this series of webinars. So let's move to the next slide. It is, as you probably already know, and I promise I won't take too much of your time to talk about SIFTA, as you have probably heard a lot about it already, but it's a program that is a significant part of InvestEU. InvestEU is the largest EU investment program that provides many financing opportunities for all kinds of sectors, all kinds of dimensions of the economy development. But luckily it also has a component that focuses on social and inclusive finance and microfinance, and provides financial instruments as part of it, but also technical assistance. So we are in the technical assistance part of this program. Let's move to the next slide. And yes, the program includes capacity building, and that is working directly with MFIs that participate in the program. And participation is relatively easy. I will say a few words about that a little bit later. So except for that, the program can offer a peer exchange program, study visit program that helps MFIs to meet with their peers in other countries and study their systems, their strategies, and their environments. It is actually composed of it has 2 legs. This program has 2 legs, let's put it like that. One leg is about project advisory and capacity building, while the other one is about rating, assessment, and evaluation. And maybe let's move to the next slide now. It covers only the EU countries, unlike its previous edition that actually also had significant outreach to the EU candidate countries. Hopefully with the next edition, The program will also be expanded to those countries that aspire to be part of the EU. As of today, the program has been extended till the end of this year. So those of you who are already in the system can benefit from technical assistance and the study visit program. We are also in the discussion with the Commission and the European Investment Bank, who is the main implementer of this program, or maybe I should say manager of the program, the next edition of it. So which are the institutions that work with you, that work with MFIs on the ground and provide technical assistance and rating support? So the left-hand side leg, and that is the capacity building and advisory part, is managed by the Frankfurt School of Finance and Management, and it works with 3 institutions: Microfinance Center, European Microfinance Network, and FEBA. So these are all providers of services to MFIs. And the assessment and rating part is carried out by Microfinance Rating. So it's an Italy-based institution that has global outreach and also works extensively in the EU within the SIFTA program. So you can still sign up, and you can see the EIB, the SIFTA EIB email address. You can write an email indicating your interest, and you will receive forms that you have to fill out. What's important is that this program is free of charge, so you don't pay for any services. All of the components of it, whether it's the technical assistance or whether the study visit programs or any other part of it, assessments, they are all free of charge. So we think it's a great opportunity. And Artur, actually, who will offer today's webinar, also works with the MFIs that are part of the SIFTA program, and may also want to perhaps add anything relevant to today's topic, in the sense, just if these issues relate to the technical assistance that we provide within SIFTA. So we have, as I mentioned, we are discussing a series of webinars. So there'll be 2 more webinars with Artur. Another one on credit scoring for small MFIs that will take place tomorrow, and yet another one on financial modeling on Wednesday. Is it the right order? Do we have the financial modeling on Wednesday? Yeah, okay, good. And credit scoring for small MFIs tomorrow. Please feel free.
Sorry, Gregor, vice versa. Tomorrow, financial modeling and planning, and
credit scoring on Wednesday.
And credit scoring on Wednesday, yes.
Very good.
Credit scoring on Wednesday.
So please feel free to join us for these webinars. We also are planning, as you probably noticed, a slide with our colleague, microfinance expert, financial inclusion expert, Piotr Koroński, also with the guest from the chair of IACOP Internal Audit, Albana Ginopouli. We have a webinar on internal audit at microfinance institutions and social economy finance providers. One important thing that I should have mentioned about the program, that it's open not just to microfinance institutions, but also to the providers of services to social enterprises. So whether we're talking about these investment groups, incubators, all kinds of vehicles and institutions that provide services to social enterprises are also entitled to be part of this program if they wish to develop their capacity to serve social enterprises. We also have our annual conference coming up on 27th May. It kicks off in Tbilisi, Georgia. We have an impressive program. We have 405 50 people that registered for this conference. It's a major financial inclusion event. We have wonderful speakers associated with financial inclusion, but also with sustainable agriculture, the new technology providers, climate finance experts, gender experts. So we'll discuss a whole range of topics, including microfinance in Cambodia and lessons learned from this sector. So we also want to reach out to other regions to see how microfinance develops there and what are certain lessons learned and recommendations for this region. If you haven't had a chance to sign up for this conference, I think we are talking last moment, literally, to do that. And please join us for this upcoming event in Georgia. Okay, so before I actually pass the mic over to Arthur, I wanted to say that the description of the webinar is I found it rather provocative. It's a provocative statement. It basically says, and let me quote, that the majority of MFIs have the mission to create jobs. However, after close monitoring, they observe that microloan is a good safety tool, but not a booster of jobs. And microfinance should not be expected to have a significant impact on job creation and unemployment reduction. Wow, this is really something that may strike many people. We all believe that microfinance contributes significantly to job creation. Is this something? Something we might be misled on, Arthur? Is this something? Is this a kind of a narrative that should be revised? And would this be a background for today's discussion?
Yes, Gregor, thank you for introduction. Microfinance creates jobs, but it creates jobs for the family or for the entrepreneur itself. It's not a booster of jobs. Microfinance is good. It's a safety net. It's a bridge loan. It's great. It played important roles in different markets in Europe, and not only in Asia and other parts of the world. However, microfinance has like more than 30 years, or is even more in other countries. And we need to do something new because family businesses disappears or grow. Family businesses are sold to others, or family businesses merge with others to solve the challenges. And yes, when we read the microfinance institutions' missions, if we take 2 or 3 MFIs now randomly, we open their website and read the mission. Their mission is saying that they are creating jobs, they're even contributing to economic development. And there are a few researches only showing how many jobs are created by microfinance. It's important, but what's next? That's the question. What's next for social enterprises, for community finance, for SMEs, for micro enterprises and small enterprises, first of all? So this is what we'll be discussing today.
Yeah. So the idea would be to discuss those innovative approaches, innovative financial instruments beyond actually traditional loans and instruments that can actually fuel job creation at the microfinance or social enterprise level, right?
Exactly. We would like to have a different look at what MFIs and microcredit providers can do to grow with their clients, first of all, to understand clients' needs and grow with their clients. And actually today we will be comparing micro-equity products with micro-debt products or with microfinance. For example, in EU, there is a definition of microloan, which is 50K, right? It's 25,000 K, I'm sorry, but you can do a parallel loan, so you can go up to 50,000 K euro. So we proposing to discuss the differences between microfinance and microequity. Would like to introduce you to new products like mezzanine products, like convertible loan products, revenue participating product, microequity product, and would like to give you insights into these new products and new investment policies and business models. And would like you to learn from private equity and venture capital, from crowdfunding platforms, from incubators and accelerators, and apply this to microfinance institutions, either directly or indirectly. Some microfinance institutions are closing down, others are selling their business to banks, other MFIs are converting into banks. And we see banking groups which do have private equity funds or asset management funds or leasing companies or other products. So I'd like now to take this time with the participants and think about what's next or what else can be done within our existing microfinance institutions to better serve our clients, how we can create additional value, how we can have additional social and environmental impact on our communities. So we'll be discussing different business models like classical private equity funds, incubators and accelerators, crowdfunding platform, business angels, and micro individual investors. So there are different business models and we can learn from them. And really, if there are 2 or 3 MFIs that wants to do these new products, we can really work on additional technical assistance that you, Gregor, just mentioned, right? They can apply for this, and I'm sure we can work tailored to the needs of 2 or 3 MFIs. Either we developed individually the product, or 2 or 3 MFIs come together to develop something regionally on microequity or mezzanine products. So this is what we would like to do today. But before, I'd like to remind how many sources of financing the SMEs have. And of course, they have donated money from private institutions or government. And in EU, there are a lot of donated capital. There are different EU programs in every country which supports SMEs for innovation, for digitalization. Then we have the equity capital, which comes from personal or family savings, or venture capital, or private equity platform, or crowdfunding platforms. And then we have the classical debt capital from banks or non-banks or microfinance institutions or bond issuers or government debt programs for SMEs. So these are the 3 categories. And I think microfinance institutions are mainly doing microloans. And even these microloans are capped at 25K euro in Europe. And what can you do today with 25K euro? You cannot buy a tractor, you cannot buy a wind turbine. Of course, you can do a small photovoltaic park with that for your social community. But if you want to build a, let's say, a health hospital or house for elder people or for retired people or people with disability, that costs a lot of money. You cannot do with 25,000 K. So when we talk about social economy, the social economy needs are much, much bigger than 25K euro loan or micro loan. So I'd like to compare debt with equity. So debt is monthly repayment. It has a repayment schedule that you need to respect. If you don't pay in conformity with the repayment schedule, immediately you have penalties or you have big fees. It might be a debt with bullet repayment at the end, but is not very often used. And debt is limited to the debt to equity ratio. It is limited to your collateral and to your assets that you own. So actually, you cannot really grow if you don't have enough equity in an SME or in a social enterprise. And when we talk about debt, we have interest and fees, and we have collateral. But when we talk about equity, we don't have a repayment schedule. We have a business plan. We have some targets to make profits in the future, and it is long term, 7 to 10 years. And you know, equity, of course, may imply losing control by the SME, but you offer some control, you offer some shares, you offer stakes to a private equity fund or to a MFI equity fund because you don't have enough collateral and because you need additional expertise to grow the institution. So if we compare, let's say, MFIs also started with equity and they grow the institution, but they also increase their equity, and other partners came with knowledge, SIFTA with technical assistance. So it's the same with SMEs. The SMEs need smart capital, as they call it now. So this is like equity capital, which comes with board members or with the experienced entrepreneurs, and knowledge transfer, which is not done by microfinance institutions. In some microfinance institutions, there is technical assistance and training for micro enterprises, but is rather broad than focused on one enterprise. And the difference between equity and debt is that you don't have interest, but you have dividends, or you have a share from the revenue or a share from the profit in the future, or you actually sell the company. If you grow a successful company, you can totally sell the company to exit. I'm not saying that the equity is better than debt, it's just different instruments for different needs. In terms of analysis of credit scoring or credit worthiness analysis or investment risk, when we look at that, we look at historical financial statements and indicators. And when we look at equity, we look at future trends. And we look at business plan and long-term plans. Yes, in some cases, microfinance institutions, when offering debt, they also look at forecast for 2-3 years in the future. But they don't pay much attention. They pay more attention to collateral, let's be honest. Even microfinance institutions started to provide loans, unsecured loans, right? But later, as they grow, they focused on collateral and security because they need to manage portfolio at risk ratio. They need to manage quality of portfolio. If the quality of portfolio measured by portfolio at risk ratio is not small, like 5% PAR or I know 7%, you're not getting new financing from new lenders. So that is not risk taker. Equity is risk taker. And if you want to change and create jobs and create impact on social and environmental aspects, you need the equity. And the equity is not mass product. It's individual, it's case by case, it's detective style analysis, it's very selective. Not all SMEs, first of all, will accept a partner. We'll talk about different equity products in a few minutes.
Maybe Arthur, you can say what's detective style analysis.
In the sense that you are monitoring this SME for a while. Let's say this SME is in your debt portfolio. So you provided loans for 3 years. And you see the entrepreneur is growing, the entrepreneur is transparent. They have growth plan, big growth plans, big impact plans on social and environmental aspects. So you're monitoring this enterprise for 2 or 3 years. And you say, actually, I want to partner with these entrepreneurs or with this team to grow the next successful entrepreneurial case in the community, or to grow a photovoltaic park, or to grow a school, or to develop an educational center, or to involve elder people in education of young people. So this is what I call detective style analysis. You observe for several years. Whereas with the microfinance, you have an advertisement, you have the loan, don't have much time. It's speed of delivery. Speed of delivery matters. It's competition between banks and non-banks in some markets. 25 years ago, there were no competition in Poland or in Romania or in Moldova for microloans.
Yeah.
But now the microloans are everywhere. So the only successful competitive advantage is speed of delivery. What else with equity, you have enough time to observe the leaders, the stars of the community that can play an important role. Okay, let me continue. There is private equity association, which is called Invest Europe. If you look at their website, they are looking at very, very large companies, but they offer good, they provide good definitions of what is private equity. So it's long-term investment. They say for small, medium, and large companies, but in some countries, private equity associations, they also invest in micro companies and in startups. So check the website. They also define the venture capital, which is more like a private equity for startup companies and early stage. And there is a nice video on Invest Europe. They explain how private equity contributes to job creation, contributes to innovation. So I'd like to learn from them and apply to microfinance institutions and to microfinance clients. We either can have a venture fund, a seed fund, or a growth fund, or we can have both. So you have here the revenues of an institution and a different type of financing that is used to develop the companies. And venture capital nowadays is more into IT. But what I encourage you is to learn from venture capital how they invest in IT and start up, as we call a boring business, a new food production, new organic agriculture business, or new clothing or textile. So learn from IT and apply to our clients, to microfinance clients, to grow them to the next level if they want to grow, because that's another issue, right? It's some small family business that don't want to grow. They're happy with what exists. So I was trying here to give a definition of micro equity, micro cap and small cap. There is definition of micro enterprises, right? And it's up to 2 million euro, the micro enterprise. But within this up to 2 million sales revenue, we can have different micro enterprises. We can have micro enterprises with less than 100K sales. We can have micro enterprises with less than 500K sales revenue. And you can go up to 2 million. The microfinance institution, they still keep like up to 50K euro micro enterprises. But micro enterprises are microfinance institutions' market. We need to serve them. And some micro enterprises actually with some microfinance institutions increased their business and they became small enterprises. And we lost them from our portfolio. We lost them to banks. We spent 5 years of growing them or 10 years of growing, and we lost them. Okay, they graduated, as we say, that one of the mission of the microfinance institution is to have, clients graduating from microfinance to banks. Okay, that's fine, but can we retain some of those clients? Yeah. So I offer a simple definition of like micro equity. It's a equity that is offered to a micro enterprise. So actually, this can be up to 1 or 2 million euro, can be up to 100K euro, can be more. You'll need to design your segmentation. But I think an equity instrument, a financing instrument that is serving a micro enterprise is a micro financing instrument. It's a micro equity or micro loan. And here maybe in EU, you'd like to change the definition to lobby and change the definition of a micro loan of 25,000K, because you're excluding other micro enterprises from this if you're limiting the micro loan. Okay, client needs first. Client needs first. So clients wants to grow, not all clients, but some of them wants to grow. They want to expand, but they don't have collateral. The problem is the same. They don't have collateral. And the microfinance is up to 50K or 25K. MFIs, their needs and their challenges is client retention, client acquisition or client retention. Yeah, client acquisition is always how to acquire new clients. But there is also mission drift that we observed, or mission achievement. If you state in your mission that you do job creation and you do economic development, then you need to add new products. And let's ask honestly, how many clients migrated to competitors? How many clients were not able to serve? How many clients grow faster than your loan product cap? And if you answer this question, I'm sure that you can elaborate new products. And you can try a new microequity product. Well, in what sectors to invest? First, you analyze what you have in your MFI. You look in your database. And when you look in your database, you see some SMEs that you'll not be able to serve anymore. So you interview those clients what their needs are, what financial products they need, what investment products they want, what business development plans. They want to start a new factory, or they want to open a new coffee shop, or they want to try a new country or a new geographical area. Do they have financing? Have they applied to the banks? They were rejected or not? But also you can ask your senior performing loan officers. Some of them are getting bored of microloans. Let's be honest with that as well. So ask those loan officers. If they're looking for jobs in banks and private equity funds, maybe you can create a job for them. Maybe you can work with them together and develop something new. And you'll retain your staff, you'll retain your clients, you'll have a bigger impact on the community. My role today is to motivate you, but also to give you some examples, to inspire you to analyze honestly what is going on in your institution and to elaborate new products. So we'll give details about the new products and to try something new to serve your communities. Okay. Several sectors for your attention. This is always food production and distribution. This can be IT sector. This can be health, sport and leisure. Can be forest and water if we talk about social aspects and environmental aspects. Can be eco-construction materials. So again, ask and interview your clients, look on your portfolio, you have portfolio statistics by sector, and you organize some focus groups, you know the product development process. You organize some lunches and coffee and breakfast with bigger clients from your portfolio, let's say, and you will see their needs, and I'm sure you can finance them, and you can provide them good solutions. I would like now to ask my colleague Olivia to put the poll. We have some questions for you. Would like you to answer quickly those questions, and then we'll go into more details. So question 1, please answer. Have you developed one or more new products in the last 12 months? It's a simple yes and no, okay? Quick answer, please. A quiz, a poll, quick. Okay. Do we have more people answering? So far, we have like 63% no new product. Okay. We'll save these results, right, Olivia?
Yes.
Okay, good.
And Arthur, we had one statement from a participant
Yes.
from Africa. Maybe let me read it.
Okay.
I think it refers to the job creation aspect of microfinance. Care and Unilever East Africa linked guaranteed franchise sales women with wholesalers and MFIs to access fast-moving goods, soap, salt, edible oil, solar lamps, etc., to distribute in rural villages at profit. Employment creation for young women and empowering. So I guess it's an example of empowerment and job creation, but requires promoting partnership. I don't know, just get Anna, if you want to maybe say a few words about this approach, this sort of a product, if you get a chance so that we understand it better.
With wholesalers and MFIs. I don't know this case, but we can have a look and maybe we can discuss at the end. If this program creates more job, like not one job per loan, but it creates more jobs per loans, that's good.
Yeah.
I mean, any new product or any new program, partnerships that creates more jobs is excellent.
Yeah,
It
absolutely. So
creates,
maybe let's keep it for the end of the webinar.
yeah.
Maybe we
Yes.
can go back to it, and in the
Yes.
discussion we can also have some
Okay, so let's
examples
have
of.
the second question. We have 63% of respondents which say no, they have not developed new products.
Okay.
So that's good. Now I would like you to answer, what product have you developed for those that developed new products during last 12 months? What product?
So we have a new business loan, a new consumption loan, new mezzanine financing, micro equity financing, payment service, savings or investment product, and to scroll down. This
Okay.
mobile application, other. So quite a range, huh?
Yeah. It's a good range, and it's expected. It's the same debt loans and payment services. So some MFIs are moving to payment or banking.
Yeah.
But it's not gross capital or risk capital.
Yeah.
And that means in some markets, there is still room for new business loans. There is room for payment services. But in those markets which are arriving at maturity, where the competition is very tough for business loans, then they need to look for new products.
Yeah.
Okay, so nobody developed new equity product or mezzanine financing.
Yeah.
Okay. Okay, good. Okay.
That means you are in the right place to learn about them.
To learn, yes, yes, yes. We're really happy that you're attending this training, and we'll give you insights of how to develop this new micro equity or mezzanine products. Okay. Olivia, can you put the third question, please?
Yes, of course.
So the third question is, do you plan to develop one or more new products during the next 12 months?
And again, for those that are planning to develop new products, you can contact or register for SIFTA, and we can help you. We or other advisors or consultants can help you.
Free of charge if you are in the EU.
Yes, free of charge. Paid by European Commission. And this is for European clients, right?
Absolutely,
for European MFIs.
Unfortunately, only for EU MFIs. Fortunately and unfortunately at the same time. Yeah.
Okay, great. And Olivia, can you put the fourth question? Is what product would you like to develop? during next 12 months.
So is the new product related to a new business loan, a new consumption loan, mezzanine financing, microequity financing? Oh, we have microequity financing. Very good. Payment
good.
service, savings or investment product, mobile application, or any other product.
Yeah, good. Good. It's good that we have participants who intend to develop microequity or mezzanine or other growth financing instruments or risk capital instruments. Excellent. Okay. Good. Let's continue. We have only 2 hours in total, so it's like 1 hour remaining, right?
Yes, exactly. We have one more hour, and then we'll have also time to answer questions. Yeah.
So next slide. Investment policy. So investment policy and strategy. Currently, you have what? You have a lending policy and strategy. Now, with the microequity products, you'll have investment policy and strategy. Okay. So you'll need to decide for yourself, is it diversified or focused? Geographical focus as well, economic sector, ticket size. As we mentioned, it can be, if your current maximum loan is 50K euro or dollars, maybe you want to say that, or maybe not to say, but after you have the interviews with your potential clients and your focus group, you'll conclude that you need something like 100K euro to 250K euro investments for your clients to retain them. So you decided on the amount, on the ticket size, and then you'll decide what instrument, okay? And let's say you want to do it in agro-food and in health. So take some diversification, not very focused. You need to diversify here to minimize the risk as well. And then the SME stage of development. Is it seed? Is it early stage? Is it growth? I always advise you to start with growth, because seed and startups is risky, is very risky. So start with growth. So you have your clients, you've monitored your clients for the last 5 years, and you picked 5-10 clients, and you want to grow with them to the next level, and you grow them with microequity. And then you need to decide if it's equity, is it minority investment or majority investment? You're partnering with them for what percentage of the share of the new venture, okay? Now going into equity products, I'm sorry, microequity, and then mezzanine is a general term, something between equity and debt. And in the mezzanine, you will have revenue participation loans or convertible loans. And we'll discuss a lot about convertible loans and revenue participation loans. And then again, I remind you the definition here. You can go in every of this category, or you create another category for yourself. Let's say you want to do investments up to €500,000, let's say. With a €500,000, you can build the educational center. Not a big one, but you can build something, right? You can build a health or hospital if it's social, or you can put a photovoltaic park. You'll not be able to put a big wind turbine, which are now wind energy turbines, which are like 1 million, 2 million, 5 million euro, depending on the size. So mezzanine loans convertible in equity. This is one instrument. And convertible into equity, this is long-term. You want to support these institutions long-term, these SMEs. This can be partial security or collateral, but also highly structured, like audit, usage of funds, approval of transactions. You're partnering with them. So if you give them like 1 million euro without security, that's very risky, right? You approve the business plan, you approve the investment plan, and you distribute the money in tranches, and you have control of usage of funds, and you have audit, and you have monthly or quarterly interest payments, or other payment conditions, or you have a big grace period which you cannot offer now with your microloan, because if it's a construction site, this might be 2 years, so you need to wait 2 years until you have first the inflows of money, of income. So convertible, you have the right to convert. You can always convert at your decision or the specific conditions. You can also have like equity collateralized, their shares, the existing shares to be collateralized to you. I know in some countries it's not allowed, but it might be like a simple notary agreement. You collateralize some shares for you, and you develop, guys, a business which is needed in the community, either electricity independence or water independence, or food, or construction materials, eco construction materials, or you plant some orchards, or you plant some vineyards, or the first equity actually was tested by a UK company long time ago, when in Cyprus, companies and in Greece were looking for long-term capital to plant olive orchards. They don't give you yield immediately after you plant them, so it's long-term investment. And the first PE fund from UK started with this long-term investment in Cyprus and in Greece. So you have this product like convertible into micro equity. Again, amount, it can be 25K to 2K. There are some researches, some companies piloted even with a small amount, like 5,000 euro, but that's too small, I think, for convertible loans and for equity products. It's too small. You better give a micro loan of 10,000K. And then the ownership in this new venture, you can have a 26% ownership or 76% ownership in this new venture, in this new photovoltaic park or educational center. So you start investing, yes. Revenue participation loan, that's different compared to convertible loan. And you'll find different definitions like revenue-based financing, royalty-based loans, revenue participation notes, revenue participation loans. At the end of the day, you share, the SME actually is sharing with you a part of the revenue. Why a part of the revenue, not the profit? Because profit in micro enterprises is hard to track. And because the entrepreneur has control of the cash, he may spend more money and the profit will be very, very small. So that is why you link this share to the revenue, not to the profit. Also, in the early stage, SMEs may not have profits. They may have some revenues, especially in e-commerce business or in other startups. They may have revenues, but no profit. So that is why you have this revenue-based raised financing. So this is a debt instrument. It's a debt contract like you have for microfinance. But the pricing is different. It's not interest rate. Again, tenor can be long-term, 5 to 10 years. The advantage for the SME is that he's not giving you control of the business. He's not losing control. Because, if you talk with a lot of entrepreneurs, a part of them will be unhappy that they sold their business too earlier, or they sold their venture because they had no capital to grow, or they got bankrupted. But revenue participation loan, it gives you liquidity for the entrepreneur, for the SME, without giving shares. Yeah. And again, it can be partial security or total security. It can be highly structured. with audit, usage of funds, approval of transactions. Maybe you won't have the right of a CFO, so maybe you'll name the CFO, you'll name the accountant there to control, or you'll name an internal audit to control this business, because again, it's risk capital, it's long-term capital, and you want to partner. Now, in terms of income, this is monthly or quarterly interest payments, plus revenue participation fee, or only revenue participation fee. And I'll jump straight forward to, and again, amount is, it's up to you. You decide between 25K to 2 million, yeah? A loan, revenue financing loan to a micro enterprise. By EU definition, again, because there are participants which are not from EU. In your country, your definition of micro enterprise might be different. Okay, so the percentage of revenue is negotiated between the finance provider and entrepreneur. And you always have a cap, like 1.5 or 2 times invested capital. And the payment obligation of the note is fulfilled at an earlier date of when the payout cap is reached, or the maturity date. The real length of the investment will vary based on the performance of the company. So the table actually will give you clarity. Revenue participation loans with revenue sharing fee only, and then later I'll show you revenue participation loan with interest as your current loan plus a fee from the future. In some legal jurisdiction, it can be also a kicker. They call a kicker from the profit. So this simple example, a company issues 300,000 euro revenue participation loan with a 5% revenue share, and the payout cap of 1.5 times the investment of the investment amount, or not more than 450,000 euros. So you have projected revenue. You still need to project the future revenue of this business. And you have the percentage of the revenue. And you have this payment cap. Yeah, because you don't want to take all the cash from the entrepreneur. Again, you're not taking share of the entrepreneur, but you don't want to take all the cash, right? You want to have a fair business with this entrepreneur. You want to have a very fair business with the entrepreneur. So you discuss the future projection, and you discuss this percentage of the revenue. Is it 5%? Is it 4%? And you discuss a cap. I mean, this cap 1.5 times or 2 times cash on cash depends on the number of years. If this is 5 years, that's one. If it's 10-year investment, then 1.5 times cap might be too small for the profitability of this instrument. Remember, you also need investors in this fund. You also need liquidity providers. You need capital for these products as well, and need to pay your investors. You don't want to take all the cash from the SME, but you want to have some money to pay investors to compensate the risk. Because otherwise, investors want to put their money in state bonds, which are very high yield nowadays. And they don't want to lend to microfinance, or they don't want to invest to private equity funds or revenue participation loan funds. So it's clear. Maybe some questions here. It's simple, right? No questions?
Are there any questions? Are there any questions about mezzanine products? And just these mezzanine products were, just what type of micro SME do you think they would be suitable? Just would they be suitable for the types of micro enterprises that MFIs work with? Just more kind of growth potential startups. So just what would you recommend here?
It can be for startups. It can be for growth capital. Any SME that wants to grow and the microfinance institution cannot provide that amount of loan, let's say 300K now in this example.
Yeah.
And the bank cannot provide it either because there is no collateral.
Okay.
So there is a missing middle between banks and MFIs. That's my statement. There is a missing middle. There is a niche between MFIs and banks. If you go to the bank, they say collateral. I don't have collateral for 300K.
Mhm.
If I go to MFI, the MFI will say, well, maximum I can do 100K loan today or 50K loan. And if I go to a classical private equity fund, they say, oh, it's too small. It's too small. Because the private equity funds, they look at the big deals, like small companies, not micro companies. And then I either stay like that as a business, don't grow, or die. I remember a lot of small food shops long time ago when we started microfinance, and then big shops, retailers, EU chains or other chains came into the market, and small food retailers were not able to compete because they had no access to long-term capital to build the second shop, the third shop. So these are general, but sectors can be food production, can be IT, can be construction materials, can be transportation, logistics, everything, photovoltaic, alternative energy efficiency. Any SME that is graduating slowly from MFIs and not getting served well by the banks.
Okay.
Yes.
And I just recall that Germany, for instance, has created it's actually a government, a state micro mezzanine fund, and just to finance exactly the type of enterprises that you mentioned, and they have not only SMEs but also startups, also new promising enterprises that were set up by unemployed people, that are run by women, social enterprises operating on commercial principles. So basically all of the range of enterprises that are typical for microfinance. So I guess in Germany where there's no microfinance as such, where all the microfinance is done through the banking sector, I think the government does what MFIs can do, just in other countries. So it's an interesting
Yes,
example.
mature markets like Germany and USA, they have government programs.
Exactly.
Of course, they can be distributed via different financial partners, but they have government programs. But in emerging markets or frontier markets, government are not able, they don't have money actually to start these new products. So should be done on private basis. Okay.
But it's interesting that the interesting point is that they recognize that the loan may not be a solution for certain type of enterprises, so they create this quasi equity micro mezzanine fund that actually provides longer term, longer term capital, longer term financing to these enterprises that are typically served by microfinance institutions.
Yes, don't leave, please, because at the end I'll give cases from Europe as well, even from mature markets like Italy or Netherlands. They still have private revenue participation funds or equity funds, even though the government has support, that there are private initiatives which are doing quite well and serving their niches. So this is one revenue participation loan product. And another one, let me change the slide. Okay. Or maybe before explaining again the benefits, the advantages. So for the investor, liquidity is achieved much earlier than with the equity, as payments begin flowing back to investor when revenue starts flowing to the company. With the equity, you need to sell the share, right? With the revenue participation loan, when the revenue starts to grow, you take a part of the revenue back to the investor. It significantly reduces investor management conflict that can arise when returns are tied to the company bottom line. Due diligence is simple than with an equity investment, as there is no concern about the company's valuation or exit strategy or how much of the company I need to sell to the investor. For the entrepreneur, the advantages are investor payments are tied to the company revenue rather than to amortization schedule or repayment schedule, reducing cash flow concerns. The incentives for the investors in the company are aligned with the revenue growth, because if they agreed the business plan, so they know the revenue, they just need to do it, of course, that's most complicated, but they agreed the revenue growth, and they agreed the share from the revenue. Investors have a direct incentive to promote the company and increase its sales. So investors is still also involved to help the SME to grow, to increase the sales. Company stock is preserved for later funding rounds. The capitalization tables investors do not change with the issue of the loan. So the shareholding structure is the same. If I started the SME and I sign a revenue participation loan agreement, I'm still 100% owner of my company. So company valuation is not a concern, it's only revenue a concern. Voting rights should not change, plus there is no dilution of management or board control. There is no risk that the new investor will change management or change financial director or CFO. Your business does not need an exit strategy. It's kind of, they call it self-liquidation exit. So you exit from the company cash flow. So that's why it's more like a loan, yeah? It's in the middle between debt and equity, but it's not pure debt, it's not pure equity. And allow both the investor and investee to share the risk and reward of the enterprise more flexible. So there are definitely advantages. Talk with some IT entrepreneurs. They are unhappy because they offer the control of their babies in the companies. Yeah. Now the second revenue participation loan, it has another component. It has interest rate component, like your microloan currently, and it has the revenue payment. That's better for the investor because some interest is coming into your fund for your current operations. And it's better for your profitability because a revenue is coming later on, a percentage of the revenue is coming later on. So this is an example of a 100K loan, revenue participation loan, RPL. 5% annual interest rate and 5% revenue share, and a payout cap of 2 times. So if the revenue is higher, then all the revenue stays with the entrepreneur. You take only 2 times. So you take 200K at the end if the business is successful. If the business is not successful, well, there is risk for your MFI, of course, as always. That is why I recommend you to start also partially collateral. So if 100K euro is for building a building, take that building as collateral for the first stage. So just in case something is going wrong and there is no revenue, then you can sell that part of the building, or you can sell some construction materials at least. So that's why I mentioned at the beginning is partially collateralized. It can be totally collateralized if you want, and if the entrepreneur is ready and does not have other. But again, if he has collateral, then he goes to the bank. He goes to the bank and he takes a loan at 4% in Europe. In Europe, 4% interest rate. So he does not need to overpay 2 times to the revenue participation fund. So I think it's clear, right? With the revenue participation, Or maybe some questions? If yes, please.
Any questions?
No?
And
Okay.
Actually, how we have two questions coming through the chat box.
Okay.
So the
Waiting.
first one is, how is the revenue rate 1.5 decided? Regulation?
The cap. Okay.
The cap, yeah.
So, yeah, 1.5 cap or 2 times the investment, 2 times cap is not by regulation. It is first decided by the fund profitability exercise. So you need to have this fund profitable or this product profitable. So product profitability, you know your costs, cost of funding, profitability, operational cost. And you need to decide what you want to make annually and what you want to make as profit in 5 years time or 10 years time, the life of the fund. This first step. So you've done your calculation at home. I take this money, I promise to my investors 10% annually or 5% annually. So I need to add my OPER cost and my profit, and I need to decide what is the maximum cap. Then second step is negotiation with your client. You look at the client profitability business model as well. You don't want to take all the money from the client. He'll be unhappy long term. He might be happy short term that he's doing his dream, he's implementing his dream. Entrepreneurs are dreaming, they're happy that they're implementing the dream, but then after 3 years, he's unhappy because he's not remaining with a lot of cash he was believing in. So you negotiate with the client. So you don't take like 40% annual interest rate, right? Annual yields. That's, you will not consider this fair. Like 50%, 15%, 20% annual yields will be good. That 20% annual yield in 5 years means 2 times cash, right? Two times cap, payout cap, 2 times. So 5 years, 20% annual. You don't getting annually that cash, but you kind of calculating it because you need to pay your investors. 1.5, if it's 5 years, let's do a simple calculation. So what is annual yield if it's 1.5 for 5 years? So this will be 50. So it'll be 10% annual yield. If it's 1.5, it's 10% annual yield, okay? So that's, I hope I answered the question. Yeah, it's first your mathematical calculation of the fund, your fund profitability, your cost of money, plus risk, plus profitability, plus OPER cost. And second is negotiation with your entrepreneurs. Of course, entrepreneurs, they always want to get the cheapest loans or the cheapest source of financing. But your negotiation with entrepreneurs is, look, you're not giving ownership to anybody. Yes, you pay a little bit more than a commercial bank loan, but you cannot get that commercial bank loan. So don't look at the interest rate at bank loans because you don't have collateral, so you don't get it. So it's a good deal between equity and commercial debt with collateral. If you have collateral, then you borrow from the bank. But again, it might be not enough to implement your new health or sports center or, hospital. Okay, and is there any other question? There is a second question?
That was the only one.
The only one. Okay, good. Fine, let's continue. Microequity. Microequity means that you as an MFI or your fund as a spin-off from the MFI takes shares in SMEs. And you take between 26% to 76% share ownership. Okay. And the amount, again, 25K to 2 million, you decide yourself what are the needs after the interviews with potential clients, best clients from your existing portfolio. Tenor, again, long term. It can be shorter, again, if they have some needs for short, it can be shorter. But usually equity and revenue is long-term loans. You're coming to solve long-term financing problems. There is no collateral at all here with equity. That's the advantage. The disadvantage, you give shares from the entrepreneur point of view. From the fund or MFI point of view, you need to co-manage this institution. You don't want to manage it every day, but you need to be a member of the board, you need to be partners, you want to meet monthly or quarterly to see how your photovoltaic park is growing, how your health center is growing, how your educational center is growing. Your income stream is preferred income, annual dividend, or at the exit in 10 years. That's a long-term investment. It's like Buffett is saying, he's long-term investment. He's waiting long-term. So this is very, very long-term investment. You need to have long-term investors as well. You need to take a part of your MFI profit and allocate to this product, or you need to talk with your MFI shareholders if they're ready to put additional equity for this new product. But that's doable. The mature MFIs, they can allocate a part of their product for, or part of their profit for their new product, micro equity. Okay, so that's a simple, again, lawyers can draft very sophisticated equity contract, but this equity contract basically will be your charter, your statute in the new investee. Yeah. For micro equity, you need experienced managers with the SME. You can also promote your SME lending team and branch managers because they have acquired a number of skills in certain business sectors. They know agro-food production, they know transportation very well. So they acquired knowledge and they see where the business can grow. But additionally, you need some training in venture capital and private equity. You need to solve the liquidity issue. You need capital for that. You need clear investment and risk management policy. How do you select SMEs? How do you research the market in what niches you want to grow? And let me give you a hint here. Research, merger, and acquisition. What are the deals in the country or in the city? Who is buying what companies? What is the trendy sector? Alternative energy, energy efficiency, organic agriculture, you know, where do you want to grow? What's next? Bicycles, mobility, where do you want, you know, charging stations? You'll not be flying with rockets to Mars with micro equity, but you know, you want to develop some, you know, chair in your office which is generating electricity while we are sitting at this webinar and listening to the webinar. So you need to decide your sectors and segments. And main exits will be based on cash and repayments in the future as a long-term loans, or it might be as you sell. You sell this share back to the entrepreneur, or you sell this share to a strategic investor or to a bigger private equity fund. Now, for micro equity, we believe to scale up, you'll need a separate legal entity and legal institution with separate policies, just to limit the risk. We'll talk at the end about business models, but think about that in some jurisdictions, you'll need a separate legal institution. Now, micro equity, for the investor, possibility to increase and add value to the business. So really, you need to add value to the entrepreneur and to the enterprise. Possibility to double the value of the money invested and control the impact of job creation in the society. For the entrepreneur, reliable long-term partner, no monthly repayment, grow the business to a market leader or to a regional leader. So there are some advantages. There are different products for different needs. So with micro equity, you're becoming a shareholder. Look back at your MFI. Who are your shareholders? How you increased your shareholder structure. Your board became more and more sophisticated. Your board meetings became more and more sophisticated as well, longer and longer. Your board package and reporting package became complex, but you started to work as a team. So the micro equity will help an enterprise to move from family style business to corporate style business. You can exit with micro equity by going on alternative stock exchange. For example, in Romania, there is alternative stock exchange. They can accept deals of 1 million euro. They can accept smaller deals for exit. You can issue a bond as well in Polish stock exchange or in Dutch stock exchange or alternative stock exchange in the Netherlands, in smaller markets. You can sell to a group of local individuals, wealthy individuals, which are looking permanently to invest, and suddenly they see that you prepared a very investable case, transparent case with reporting, with audit. You show that you make money with this company. So if you show that it's transparent and you make money, it's easy to sell. That's micro equity. Now, the investment process, we were talking about lending process for microfinance institutions. Here for micro equity, we're talking about investment process. You need to decide about sourcing and pre-selection of potential micro and small enterprises. How do you source them and how you pre-select? We discussed about, let's say you take top 50 debt loans, 50 clients from your MFIs, which are borrowing the biggest amount of money. And you see that in 1 or 2 years, they'll graduate, they'll go from your MFI. So you select them and you work with them. Then you look at valuation and deal structuring. What is their total equity? How much money they need? If they sell you 50% of the company, how much money you need to put in? So you need to do some Excel forecasting and modeling. And you need to agree with them on their business plan and their future revenue. And then investment decision, you need the investment committee as well, a credit committee, investment committee, and value creation. What can you add to the SME? You can add reporting standards or sales standards, or you can bring a designer from Italy to improve the design of the furniture. How you can create value. That's the biggest difference. We say that microfinance institutions, we help SMEs and we train micro enterprises, but we don't really create value there as microfinance institutions. Entrepreneur creates value with the loan, yes, but our role is limited as debt providers. With equity, we are board members. We're discussing with CEO and CFO. We can really ask to have an impact policy, social measurement, profitability measurement, and we can add value. We can learn together with them. Risk management, do we take collateral? We don't take collateral. What if the CEO or the entrepreneur is not willing to continue with us? How we get out of these ventures? Exit strategies. And yeah, in the investment process, you need to put some cases. You need to show to investors pipeline, some examples of the SMEs, that you want to finance. And I'm sure you'll find in your microfinance portfolio entrepreneurs that want to grow, entrepreneurs that are looking for partners because they don't know how to grow. They want to grow, but don't know how to grow and don't have capital. And if you have equity, then you can borrow more money from the banks. There is a leverage effect. You can borrow more money from the microfinance institution as well. And you create more jobs. You create 20 jobs, 50 jobs, 100 jobs per investment or per enterprise, not 1 or 2 or 5 jobs. That's the beauty of micro equity and revenue participation loans. It's not an easy product. It's not a mass product, but it contributes to impact and to the social aspects. And it contributes also to the profitability of your capital, of the MFI capital. Micro equity is a complementary financial tool for a segment of micro and small enterprises, some niches. It's patent capital. If it is a crisis, COVID or a new war, hope will not be any more wars in the world. If it's a regional conflict, you need to repay your loan. You need to repay your loan to microfinance institution. You need to repay your loan to the bank. With equity, you can wait for better times to exit. In the bad times, you'll concentrate on something else. You'll reinvest. You'll do innovation, digitalization. So it's patent capital. It can wait 1 year more. And actually, when you structure an equity fund, they always say it's a 10-year fund plus 1 plus 1. What that means? That means if there is a crisis, they can extend 2 years. Or they say they start a fund for like 7 years period, and they say 7 years lifetime of the fund plus 1 plus 1. So they have 2 years to expand. So it's patent capital. Can be applied for many sectors and industries that grow. That's important, to grow. Has the potential to become a new financial industry niche for micro and small enterprises. In some countries like UK, private equity and venture capital, it's a big share of the GDP. It's a big share of the total financing. In other countries, these instruments are 0.0001% of the total financing instruments and of the GDP. So it has the potential to become a new financial industry, this micro equity. Okay, as a summary, for the first part, we have the second part, business models and cases. So start with idea generation. Look at your team, ask your team if there is anybody interested in micro equity. Look at clients, meet with clients, travel around, read about private equity, Invest Europe or other private equity and venture capital association. Read about merger and acquisition. Who is making money on what? What are the community needs and priorities? So look at the idea. So define your universe. This is the second stage. Find fund strategy, geography, sector, type of SMEs, startups or growth. Then debate and decision making, potential list of SMEs and exposure per sector. Analyze potential SMEs like markets, trend, and management. And you need good management and good markets. If the market is growing and you have good management, then you'll make money and you'll have impact. Capital needs and valuation. So you need to look at total assets, total profitability of these companies. And because they are your clients, you have their financial statements, and it's easy for you to do that. And then construct a portfolio of like 10 to 20 companies with the average ticket size of 0.5 million euro or 1 million euro. Watch those enterprises and observe, detective style, watch observe those enterprises for half a year or 1 or 2 years, depend what time you have, and then start the fund. Start the fund. Or if you sold your MFI, put your money in the equity fund straightforward. So we have, again, debt, and we have equity, and there is a potential here for microequity between microfinance institutions and banks and private equity and venture capital, commercial institutions, okay? You can also read what big private equity funds and venture capitals are buying and selling. That's a good always piece of information. Okay, we're moving now to microequity business models. So talking about institutional business models, your companies can be bad, alive, okay, good, or great. So you'll always have like one company which is bankrupt, a company which is surviving, and then a few companies that are great companies, and they'll pay basically your return. Yeah. So look at this, you know, and try to think in the future who'll be your stars from your portfolio. Now, institutional business models, private equity funds are typical limited partnership agreements between limited partners and general partners. General partners, these are managers, these are you guys, managers, and limited partners, these are investors. Why they're limited partners? They're limited partners because they're capitally limited and they are not involved in management. Then there are limited partners, which are institutional and individual investors. So in your fund, you can have individuals investing, or you can have some institutions. You can have several MFIs, or you can have a bank and an MFI partnering together, or you may have municipality partnering with MFI. General partners are managers of the fund. Managers of the fund will be a separate company in this business in some legal jurisdictions. In MFI, you guys, management, you are employees of the MFI. You don't have a separate company for the management. But in the equity business, the management company is a separate institution because they can manage several funds. So an MFI is usually what? A limited liability company or joint stock company. Management is paid salary-based for the same company that provide loans. As an MFI, if the law allows LLC or GC can invest directly in other companies, then you can start investing from your MFI. So if your local law allows you to invest from your LLC, your MFI is an LLC, if allows to invest, you can start investing as a pilot base from your existing institution. Or you can create another LLC specifically for microequity. If it's a revenue-based loans, you can actually keep it in the same balance sheet in the same company. But if it's a microequity, you may want to set up a new company. It's not a big deal to set up a new simple LLC. Make sure that in some jurisdictions, if you collect money from individuals, this business may be licensed, and you will need to get a license for asset management and fund management. But if you invest your own money and you invest the private money from institutions, you may not need to get a license. So again, for the best legal structure, you'll need to consult a lawyer. Maybe have your internal lawyer or external lawyer, but you'll need to consult your lawyers. A classical equity business model will be like different investors, like donors, financial institutions, private investors. And then you'll have your microequity fund, an LLC, a limited liability company or limited partnership. Then you'll have your microequity management company as a separate company. And then you'll have your investees, like 10 companies. And if this is a €500,000 average ticket, then this will be a €5 million fund for your first fund. And I think that's doable. You can put some money, you can borrow some money or take some money from other financial institutions and develop a fund with a special social mission or special environmental mission. Now, crowdfunding, I don't want to go into crowdfunding too much. Crowdfunding is more like a broker, like an intermediation. So you'll have different small investors. In EU. Crowdfunding is regulated. There is a new regulation, so you need to register. You need to get registered as alternative broker, another crowdfunding platform. 2 or 3 MFIs may start a crowdfunding platform. Some MFIs actually started already. Others started and stopped. I mean, you can learn from this as well. My advice, because I'm explaining different business model, this model exists, but my advice is to start as a simple classical private equity fund to invest directly from your own money and show good results, and then you can go to public, because again, crowdfunding in a way is kind of public. Going public and asking individual investors to invest 100K or 200, not 100K, but 100 euro or 50 euro or 200 euro. So I have a lot of small individual investors. So it'd be good to show good examples first. So from your pilot stage. When designing micro equity business models, you can apply the Canvas business model or future search. So you look at market segments and ideal clients, financing products, organizational structures, incubators, accelerators, and you can join different meetings at the incubators and accelerators, and you'll see some companies growing there. And key resources and partnerships, first loss investor is crucial. First loss investor or first catalytic capital is crucial for the success of these micro equity funds. Entrepreneurs who exited from their ventures may contribute to equity fund creation. Top managers may contribute to a micro equity fund. Municipalities and the government may initiate a micro equity program. EU funds, big private equity funds may want a social and impact, smaller funds. Insurance companies and banks may create a micro equity fund. So now micro equity business models apply to microfinance. You can start with an in-house growth program. You can start with the micro equity department, micro equity fund or micro equity crowdfunding platform, or partnership. I would like to see 2 or 3 MFIs getting together and doing a micro equity fund regionally. Because bigger equity fund investors, they prefer regional funds, not one country fund, but regional funds. And wealthy individuals, they also prefer like regional funds. So 2 or 3 MFIs, if they can come together and start up a fund, I'm really happy to help and develop this and then showcase to others. I mean, you can experiment with a product like from 100K to 500K euro. You can develop a growth program for current clients with an option to finance them at the end, kind of accelerator within your MFI. Again, creating a micro equity department with an MFI or launching your own micro fund or crowdfunding platform. Create a partnerships. Partnerships, they're not easy, but the impact is bigger. So several MFIs, maybe a private equity firm, a local government, universities. Universities in USA, they invest in funds. Harvard University has its own fund. I know even a smaller university, they have their own funds. In Europe, universities are investing less and less because they're government dependent. But maybe you can convince some universities to invest together with an MFI, with the local government. That will be great case, great success. Association of Microfinance Institutions maybe want to invest as well. Or maybe can be catalytic in the sense to organize more MFIs institutions to talk about these new products, to create more jobs. So we have that, we have equity, and in the middle, we have a variety of products. And we have SMEs which cannot get money from the banks, SMEs which cannot get money from microfinance institutions for their growth. So definitely you'll find 10, 20 excellent entrepreneurs with good management team or happy to develop management teams and happy to move from family business to corporate business. Now, some examples, pure equity. This is Biscaya Seed Capital from Spain, from Basque Country. Anders Invest from the Netherlands. Anders Invest from the Netherlands is an interesting case because they are kind of a cooperative. They have farmers, successful farmers, which retired and invested in Anders Invest. And Anders Invest provides equity to other companies in agro-food, not only in the Netherlands, but in other countries, and in real estate, in health, in engineering. So Anders has like more than 100 individuals as shareholders. Seed Capital Biscaya is an asset management company. It gets money from municipality, a lot of money from municipality and from European Investment Fund and EU funds. Revenue participation loans. There is one interesting case. We are uncapped. It's a good name, actually. We are uncapped. Fast, flexible funding from 10K to 2 million pounds investment. Lighter Capital is in USA. Also an interesting revenue participation loans case. You can have a look. Continue with cases. We have equity kind of crowdfunding. It started in Romania, SeedBlink, but is Central and Eastern European now. It's very active. It's more to IT, but again, we can learn from IT and apply to non-IT sectors. And there are angels investors there. There are funds. There is a good community which can really help an enterprise that is starting to get like €500,000, €1 million equity, pure equity investment. There is Euro Equity. There is Mimosa in France. It's interesting, purely for agriculture, agro-food. There is also an accelerator with revenue participation loans. It's the equity fund and universities. This is Spheric Accelerator. There is Gazelle Finance in Georgia with revenue participation loans. And the list is big, actually. I pre-selected a few of them, but the list is big. For example, I'm sharing with you a link to 14 plus best revenue financing companies in USA, Asia, and Europe. One interesting one for Europe is Pipe. They have this revenue participation loans for European countries. There is one interesting Recap. And with Recap, you can get additional services like value added. You can do accounting automation. You can do liquidity analysis service. You can have other services except financing. So having said that, we're arriving at the end. Do we have a few more minutes? We actually consumed our time. I'm happy to open the discussion. Let's have an open discussion about micro equity, about new product development for growth, for SMEs growth. Payment service is good for an MFI, but it's not SMEs growth. It's no social impact, no job creation, little job creation. New loans for SMEs is job creation, yes. But micro equity and revenue participation loans is job creation and risk taking and high impact. So let's have a discussion. Tell me about your experiences with these new products, at what stages you are. And we're happy to continue on an individual case. Again, if there are today 2 or 3 MFIs that want to join, work together, we're happy to help. Or if you want to work individually, we're also happy to help.
So good, excellent. So are there any questions to Artur? Let's take advantage of him being with us on this interesting topic. And yeah, ask questions to, please feel free to ask questions to Artur. I know, Artur, that some MFIs were experimenting with microequity, but they really didn't, just take off. Do we know what happened? Whether there were certain pieces, infrastructure pieces missing? Just whether there were legal problems, whether there were some viability problems. Just what. Do you know what could have gone wrong?
Well, one problem is that capital is scarce and there is always need for capital, either for microloans or for microequity.
Yeah.
And if the capital is scarce, I mean, you don't have enough investment capital or lending capital, then they prefer to stick with the microloan.
Okay.
But if you arrive at maturity in a market, you basically need to think what else, what next. Also, you don't need to wait until your clients or half of your clients already move to competitors or move to banks. And I mean banks as competitors, right? Want we or not, MFIs which are not bank yet or have not converted into banks, it's hard for them to compete with bigger banks or regional banks or banking groups. There are some also legal aspects, but I'm sure a good lawyer will avoid legal aspects. You can always invest. Nobody can stop you to invest in other SMEs, right? But if you start collecting public money, then you need to get a license. Yeah. And then is always proper management for that and management willingness, MFI shareholders board and management willingness to do this. And then naming a proper microequity management team. Yeah. So, and then risk is everywhere. So if you pre-selected the wrong case and you have only 1 or 2, that's not a good pilot phase. You need to have more, like 5, 7 cases. Because if you pre-select 1 or 2, I remember one institution piloted 3 cases and 2 gone bankrupt. And 1 case was not enough to cover the losses, so they decided to stop and then re-enter later. So these are the risks, but potential exists. And
we actually have a question in the chat box. So how do companies search for financing?
Can you repeat, please?
How do companies search for financing? I mean, it probably refers to microfinance.
Meaning microfinance institutions, how they search financing for this new product.
I think so, for financing, for funding for those new products. How can they, just whom they can approach? And
I don't know what they mean, if they mean SMEs or they mean MFIs. If
can
they
you
mean
please,
MFIs,
Marina, can you specify whether you mean SMEs or MFIs?
Okay, info on both.
Both.
Yeah.
Okay.
Yeah, I mean, MFIs can take at the beginning a part of their profit for new product development. Then they can go back to their existing shareholders.
Mm-hmm.
And then if they're in EU, they can go to EIF, European Investment Fund.
Exactly. That's a great idea. Yeah.
They can also go
Or
to
maybe work with their own
individuals,
governments. So
wealthy individuals in their country or in their region.
exactly.
Club of entrepreneurs, accelerators, angel groups.
Development banks.
Development banks, yes. Government programs.
Yeah.
They can go to municipalities. It's a great program for municipality to create jobs.
Mm-hmm.
They can go to universities.
Yeah.
This is the fundraising for the MFIs. Now for SMEs, I mean, SMEs, they always look for financing. What do you find them if you start a standalone program? You find them again at conferences, at events, specific related events, either agro-food exhibitions. So you go at exhibitions and observe, and they are there, or you go to, association of, let's say, world chart producers or exporters or alternative energy producers. They're there so you can interact with SMEs. And you can go to a bank as well. And if you have a good friend, then the bank will recommend you a good client, which they rejected because the bank will recommend bad clients to you. So they rejected because collateral, business case was good, but collateral was not enough. So if the bank rejects that client, it's a good client for microequity and revenue participation loans. And then you look at your MFI, those clients which are maturing. They're growing fast and you cannot serve them. So ask your loan officers if they rejected clients because of the loan amount cap that you have today, loan amount maximum exposure that you have today. So a client came and applied for 100K, your maximum loan exposure is 50K, you rejected. And you don't know as manager, if you don't collect enough statistics, you have 200 loan officers, you don't know how many you reject and for what purpose you reject. So you talk with your loan officers and you get enough deals. And also, what are you good at as manager? Do you know IT sector? Do you know food sector? Do you know logistics sector? If you don't know, learn some sectors. Learn about sectors because you need to become not a professional in finance only. You need to become an entrepreneur in agro-food or logistics or organic agriculture. You need to learn that. So your contribution to the entrepreneur is finance. Okay, you learn from your entrepreneur furniture production, but you also learn from others, not only from the entrepreneur, so that entrepreneur is not cheating you. Now, it's a great opportunity for those loan officers and managers which became bored of microloan because it's one loan, you do the same loan for 20 years. It's an interesting new area to get expanding and learning and to get motivation. I want you guys to be motivated as you were when you started microfinance and you believe that microfinance will eradicate poverty.
Yeah, plus MFIs have those development missions, just a mandate. So, so at certain stage, I think good managers should ask themselves what the provision of microcredit is really sufficient, what they contribute to economic development, just and the answer may be that not exactly, especially in those markets which are, just more successful and are middle income or even moving towards high income markets. I think it's almost imperative to start to think what other products would give actually, just more opportunities for SMEs to grow and create jobs and economic opportunities for the country.
Yes. And we have a satisfaction survey, Olivia, now, or you'll send it later?
Maybe just one last
yes,
question.
Please.
One last question, Artur, if you don't mind, just about risk assessment frameworks, just what sort of, if you could give a few tips, just if an MFI wants to evaluate potential micro equity investment, just what sort of risk assessment framework they should adopt? Just
Yeah.
a few
If
maybe few tips
an
for.
MFI has SMEs loans, or like bigger loans, like
Yeah.
100K loans, I'm sure they have a credit analysis and credit scoring already for SMEs loans. So that can be improved to be used for equity. You need to research the market a lot here. In that niche, is the market growth? Can you grow? How many coffee shops can you open? How many hospitals? For example, one fund invested in a particular medical clinic with hearing problems. So they found a niche and they researched that more and more young generation have problems with hearing. So they invested in a separate chain of private clinics. So you need to research that market if there is growth. And entrepreneur, transparency, motivation to grow, and possibility and openness to have a bigger team. Because it's, again, remember, moving from family style business to corporate style business. And from the very beginning, try to invest in something that you build some assets. And you take that assets after they are built as collateral until you exit. Yeah. So that's why MFIs are good, because they still have in their mind like this collateral, but don't reject if they don't have collateral. That's another option, because if you're a banker oriented to collateral, you not do gross capital. You need to work hand in hand with the entrepreneur to grow the business. So it's market analysis, is business planning, and management team. You'll be working with the team here, not with collateral. So simple, but again, it's financial modeling, it's valuation, it's credit risk, and please join the credit risk, credit scoring session on Wednesday as well, and I'll be talking about the elements of credit scoring, and you'll understand that those elements can be applied for micro equity products as well.
Okay, so I think with this we
and
could.
Diversification, Gregos, at the end, diversification is always, so don't put all your money in one basket, in one sector, in one manager.
Absolutely.
Diversification. And remember, I prepared the table that you'll always have very, very good companies. You'll have companies which will bankrupt and companies which will survive. So when you mix all type of companies, you'll have a good return of 2 times cash on cash, or 2 times money invested.
So excellent. So I think now we're coming to the end. So I hope we have inspired you to think about this this new generation of financial products, financial instruments beyond traditional micro loans, and those products that we discuss can truly fuel job creation. So think of those revenue participation loans, convertible debt, or direct equity investment. And please remember what Artur said, that there is a big space between pure debt, micro loan, and pure equity products that you can experiment with and come up with ideas and products that would be very meaningful to your clients that want to grow and provide a job and economic opportunities for your community, for the area, or for your country. So let me thank wholeheartedly Artur for those 2 hours, and yes, we once again invite you to the webinar that we will have tomorrow on credit scoring, and on Wednesday on financial modeling. And yes, we'll have a very brief satisfaction survey. So if you kind of an evaluation form, so if you could fill it out when you exit, that would be fantastic. It will provide a lot of feedback to us on how to deliver better quality webinars, although this one I'm sure was excellent anyway, but still there's space for improvement. So please do that, and once you've done it, please join us tomorrow for the next webinar in the series. So thank you so much, Artur, once again, and thank you everyone for your
With great pleasure.
participation. Thank you.
Good
Thanks.
luck with your new product
And
development.
good luck with your new product development. Please let us know if you have any questions or need support with that.
Yes.
Thank
Good
you.
luck.
Good luck.
Help your communities to prosper.
Help your country. Help all of us. Take care.
Bye-bye.